Well, let's talk now to Marc Ostwald, the Chief Economist and Global Strategist at ADM Investor Service International. Marc, welcome back. What are your main takeaways from China's economic figures, particularly this worsening producer deflation and weak consumer prices?
Well, I think in terms of the inflation numbers, or rather deflation numbers, one also has to sort of have a look at some of the breakdown of this. We all recall that BYD introduced those massive auto price cuts last month, which obviously have been very effective given that the new auto sales this month were up 13.3%, with new electric vehicles up almost 28.1%. So when one looks at the breakdown of consumer prices, you see that there's a 4.3% drop in transport and communications, which is the biggest negative in year-on-year terms within there. That said, it still reflects a lack of pressures elsewhere. Basically, lack of demand basically is not creating any sort of spikes higher in inflation. On the producer price front, I would be a little bit more careful. Energy prices, clearly a big consideration. That's true across the world. It's driving down inflation in the Eurozone, to a certain extent in the UK. It's capping it in the US. It's all down to lower oil prices. It's also in China, coal prices have fallen quite substantially, which also distorted some of the trade numbers in terms of the weakness in imports was due to much more competitive domestic prices. So some of, and that, coal is being competed with both by, there is a certain lack of demand in demand from power, but that's also a reflection of a massive boost to renewables output. So this is the stuff of transition. But in effect, China is still basically a deflationary influence upon the rest of the world.
To what extent would you say these figures reflect structural issues versus short-term shocks such as the trade tensions or perhaps policy shifts?
It's a mix of the two. In terms of the trade numbers, that big drag from the US, I think it's important to understand just how big a shift there has been in Chinese exports over the last 10 years. Before the Trump 1.0 tariffs, US accounted for 27% of external demand for China. That's now below 18, and it's going to sink even further with these tariffs as they are at 40%. On the other hand, there are structural issues. I think above all, the problems from the property sector and the fact that so much money in terms of private savings is locked up in it. And, it's an enormous drag. And the fact on the other side that there needs to be a development of some form of social security, a social security net. Now, there's work being done on that, but as long as it's not there, the propensity to spend, particularly in an environment where the demand outlook is very uncertain, not only because the property sector is not contributing what it was, but also because of the external factors due to trade tensions. Pay has not been rising much for best part of 18 months. The propensity to save rises. We saw that in the Eurozone when rates were zero for so long, and people said, well, people will probably go out and spend it. Well, actually, that particular part of economic theory doesn't work at all. In fact, what people tend to do is double down on their savings. And I think we're seeing this phenomenon repeated in China.
Given all of that, then, could continued weakness in imports and domestic demand derail China's broader growth this year?
I think it's going to continue to be a mixed story. There are areas where there is a huge amount of excess capacity, particularly those areas on demand from the real estate sector, be it commercial or residential. there are other areas which are still rapidly growing, particularly the high technology areas, anything to do with renewables, areas where China just has such a quantum advantage over the comparative advantage over the rest of the world. Remember that China accounts for 70% of all intermediate goods production in the world. If anyone thinks they can decouple from that, they really need to think again, unless they have a long-term plan, and I'm talking decades, to revitalize their own industries and very deep pockets, which, as we know, in a very indebted world, is not the case.
Mark, good to see you. Thank you for that. Marc Ostwald, the Chief Economist and Global Strategist at ADM Investor Service International.